$34 trillion. You just read that. Did it feel like anything? Sit with that for a second. Not the number, but the fact that it didn't land. That's the whole problem right there. And honestly, it's the thing that got me interested in this topic in the first place. We've been saying that number for 2 years now, like a broken smoke alarm going off in the kitchen. Loud enough that you stopped hearing it, annoying enough that you learned to tune it out, but nobody actually checked if the stove was on. The smoke alarm isn't lying. It's just been going off so long that $34 trillion has become wallpaper, background noise, a number that floats in headlines and then drifts away before it ever becomes an image in your head, before it ever becomes something that feels connected to anything real in your life. And I want to talk about why that numbness is the actual problem. Not the debt itself, but the fact that the people who understand exactly what that number means have already figured out what they're going to do about it. And what they've already decided doesn't look anything like what you would decide if you knew. Nobody is lying to you about the debt. That's the thing I want to get out of the way immediately, because the easy story here would be to find a villain, a corrupt politician, a scheming banker, a shadowy cabal somewhere making decisions in a room without windows. That story would be satisfying. It would give you somewhere to point. But it's not the story. The actual story is messier and, I think, more unsettling, because it's a story about a system that has learned, over decades, to distribute pain in ways that are invisible to most people while remaining entirely legible to a small number of people who understand how the machinery works. Nobody announces it. Nobody votes on it. It happens in the data, in the yield curves.
In the difference between the nominal interest rate on your savings account and the actual inflation rate eating away at what that money can buy. It happens while everyone is watching the news, waiting for the obvious crisis that never quite arrives in the form they were expecting. So let me tell you what actually gets me about this. Politicians say the debt is sustainable. Economists say it's complicated. And you're sitting there thinking, okay, but who actually gets hurt when this eventually goes sideways? Who specifically? Because the economy suffers is not an answer. Future generations is not an answer. Those are ways of not finishing the sentence. I've spent a lot of time with this material, and here is my read: the debt number is not the scary part. The scary part is that there is a well-documented historical mechanism for dealing with it. A mechanism that has been used before on a large scale, with real consequences for real people, and that mechanism is almost never named plainly in mainstream coverage. It has a technical name. It's called financial repression. And the reason it doesn't get named plainly is, I think, pretty revealing about whose interests are served by the public not quite understanding it. Financial repression sounds like something from a therapy session. It is not. The concept was named by economists Edward Shaw and Ronald McKinnon in the 1970s to describe something that had already been happening in practice for decades. Here is what it actually means. Stripped of all the technical language, the government arranges things so that interest rates stay artificially low relative to inflation. Not necessarily through any single dramatic policy decision, through a combination of regulation, institutional pressure, and the management of expectations. And when you hold interest rates below the inflation rate for a sustained period, something mathematically inevitable happens to debt. It shrinks.
Not in nominal terms. The number on the balance sheet stays the same or even grows, but in real terms, in terms of actual purchasing power. $1 of debt that was borrowed in 1945 and hasn't been repaid by 1965 is worth a lot less in real terms if inflation has been running at 3 or 4% annually for 20 years. The debt didn't get paid off. It got quietly devalued. And here is the crucial thing somebody paid for that devaluation. It wasn't the government. It was the people who were holding the other side of those instruments, the bonds, the savings accounts, the pension funds, the insurance policies, all the vehicles through which ordinary middle-class people in the post-war period tried to save for the future. They held long-term bonds that were paying, say, 2.5%, while inflation ran at 3.5%, year after year, for 2 decades. The real return on those instruments was negative. The savings didn't grow. They quietly shrank in purchasing power, while the nominal balance stayed the same, and nobody who owned those instruments felt like anything dramatic had happened, because nothing dramatic did happen. There was no collapse. There was no crisis. There was just a slow, steady, invisible transfer of real wealth from savers holding fixed income instruments to the government whose debt was being eroded in real terms by the same inflation those instruments couldn't keep up with. Think about what that means concretely. A person who retired in 1965, let's call her Margaret, because she was real. Even if this particular Margaret is composite, had spent 30 years dutifully putting money into savings bonds and pension funds, the way every financial advisor and every cultural norm of the era told her to do. She had done everything right. She wasn't speculating. She wasn't taking risk. She was doing the responsible, middle-class, post-war American thing, saving systematically in the instruments the financial system told her were safe.
And for most of her working life, they were safe, in the sense that the number in the account went up, never down. But the real value of that number, what it could actually buy, was being quietly eaten away by the gap between inflation and the interest her instruments paid. By the time she was drawing on those savings in the 1970s, the purchasing power erosion was significant. She wasn't broke. She wasn't wiped out in any dramatic way, but she was quietly, invisibly poorer than she would have been in a world where her savings had kept pace with inflation. She didn't know she was in the pool. She was already wet. And the mechanism that did that to her, financial repression, in its post-war American form, also happened to be one of the primary tools by which the United States managed its enormous World War II debt load down to manageable levels over those same decades. The debt shrank in real terms. Margaret's savings cushioned the fall. Nobody voted on that arrangement. Now, the Federal Reserve is officially independent. I want to be careful here about what I'm claiming and what I'm not claiming, because this is where people sometimes hear more than is being said. I am not claiming that the Fed will deliberately engineer financial repression in some conspiratorial sense. What I am saying, and this is something serious economists debate openly, is that the Fed's independence is a convention, not a law. It exists because Congress has chosen to allow it to exist, and because successive administrations have chosen to respect it, and because the institutional culture within the Fed has internalized independence as a core value. All of those things are real, but none of them are immutable. Conventions are what they are, agreements among people and institutions that hold until they come under sufficient pressure.
And when a government is facing the arithmetic reality of debt service costs that crowd out an increasing fraction of the federal budget, when interest payments are consuming a larger share of revenue than defense, than Medicare, than almost anything else, the political pressure to find relief is not nothing. It doesn't generate a dramatic confrontation between the president and the Fed chair. It generates a slow ambient pressure in the direction of accommodation. It generates appointments. It generates framing. It generates the gradual redefinition of what appropriate monetary policy looks like when the alternative is a fiscal crisis. None of that is dramatic. None of it makes headlines the way a default would. And that's precisely the point. Let me tell you about something that happened in 2022 that I think is the most instructive recent data point on this entire question, and that I think was badly underreported in the American press. Liz Truss became Prime Minister of the United Kingdom in September of 2022. 45 days later, she was gone. That is the fastest political exit in modern British history. And it was not driven by a scandal or a parliamentary rebellion or a medical emergency. It was driven by the bond market. What happened? Truss announced a package of unfunded tax cuts. The idea was to stimulate growth by putting money back in the hands of high earners and businesses. The fiscal math was, to be generous, optimistic. Within 48 hours of the announcement, UK government bonds, gilts, collapsed in price. Yields spiked. The pound fell against the dollar. And then something happened that the American financial press covered mostly as a footnote, and then moved on from the UK pension fund sector, very nearly seized up entirely. Here is why, and this is the detail that matters for understanding what's actually fragile in the current system. Not just in the UK, but here.
UK pension funds, particularly defined benefit schemes, the kind where the fund promises retirees a specific monthly payment for life, had for years been using a strategy called liability-driven investing, or LDI. The basic logic is sensible. Your liability is a long-term promise to pay people money in the future, so you want to hold assets whose duration matches that liability. Long-term bonds are the obvious instrument, because their cash flows extend far into the future the same way your pension obligations do. The problem was leverage. In the years of near-zero interest rates, pension funds had been using their long-dated bond holdings as collateral for leveraged positions, in some cases 3 or 4 times levered, to juice returns in an environment where safe assets paid essentially nothing. Again, not crazy. Understandable, given the environment. But leverage is a tool that works smoothly until it doesn't, and what it doesn't like is fast rate moves. When gilt prices fell sharply because Truss announcements spooked the bond market, the funds faced collateral calls, margin calls, essentially, on those leveraged positions. To meet the calls, they had to sell assets. The asset they had most of was gilts. They sold gilts into a market that was already falling because people were selling gilts, which pushed prices lower, which triggered more collateral calls, which meant more selling. A textbook liquidity spiral. Not a solvency crisis. These funds were not insolvent. They hadn't made bad bets. They had made the bets every serious pension fund manager was making, but a liquidity crisis that could have cascaded into something much worse if the Bank of England hadn't intervened with emergency bond purchases to break the spiral and restore orderly markets. They did intervene. It worked. The crisis was contained. Truss resigned.
The episode was treated by most of the American financial press as an interesting story about British political dysfunction, with some color about bond markets being important. And then it was largely forgotten. The detail I keep coming back to, the one that hasn't left me since I went down this rabbit hole, is what happened after the crisis was contained. What changed about the LDI strategy that nearly broke the UK pension sector? Broadly speaking, not much. The leverage came down somewhat in the immediate aftermath. Regulators made some noises about prudent risk management. And then, over the following months and into 2023, the leverage began to creep back up, because the underlying logic that produced LDI in the first place hadn't changed. Pension funds still have long-duration liabilities. Safe assets still pay relatively modest returns. Leverage still improves apparent performance in normal conditions. The incentive structure that produced the vulnerability was intact, and nobody in institutional finance is paid to publicly say the entire framework we've been using is structurally fragile. That's not a career-advancing position. So the lesson from the near miss was functionally nothing. The system processed a near catastrophic stress event and resumed operation in approximately the same configuration that generated the stress, because changing it would require admitting something that the system is not organized to admit. Now imagine that scenario in the United States. Not a direct replay. The contexts are different in important ways. The dollar is the global reserve currency. There is always structural demand for U.S. Treasuries as a safe haven asset. The U.S. economy is larger, more diversified, with more buffers. I am not saying a trust-style episode will happen here. What I am saying is that the underlying vulnerability, institutional leverage built on the assumption that rate changes happen gradually enough to manage, is not a uniquely British problem.
U.S. pension funds, state and municipal and corporate, use analogous strategies. The U.S. insurance sector has enormous long-duration bond exposure. The entire architecture of institutional finance globally is built on assumptions about rate volatility that the Truss episode briefly and terrifyingly revealed to be assumptions rather than laws. So let's walk the scenario, just to make the abstractions concrete. Imagine Congress passes something, a large unfunded spending bill, a tax cut, a combination that moves the needle enough on the debt trajectory that bond markets reprice meaningfully. Not in a gradual, manageable way. Fast. 10-year Treasury yields spike from, let's say, 4.5% to somewhere near 7% in a matter of weeks. The way UK gilts moved in October 2022. What does that world look like? Mortgage rates follow. Immediately, the 30-year fixed mortgage goes to 9-10% overnight. The housing market doesn't slow, it freezes. Transactions collapse because no buyer can afford the new payment math, and no seller wants to accept the price adjustment that the new payment math requires. Home builders halt construction. The residential construction sector, which employs a significant portion of the American workforce, sheds jobs fast, not because of bad management or poor products, but because the math stopped working and nothing else changed. Municipal bonds track treasuries, so cities and states suddenly face dramatically higher costs to refinance their existing debt before they've approved a single dollar of new spending. The cost of running a city goes up automatically, driven entirely by the interest rate environment. Corporate bond markets seize up. Companies that had been planning to refinance existing obligations at 4% rates face costs at 7% that make otherwise healthy businesses technically unviable.
Layoffs follow. Not because revenues fell, not because competition arrived, not because strategy failed, but because the cost of money went up faster than any operational adjustment can compensate for. And now the Federal Reserve is cornered in a way that is genuinely uncomfortable to think through. The traditional response to a bond market seizure is to buy bonds, quantitative easing, emergency asset purchases, the same playbook that was used in March 2020 when pandemic panic hit markets. But March 2020 had essentially zero inflation. The current environment does not. Buying bonds at scale when inflation is already running above target is adding fuel to a fire you are simultaneously trying to put out. The Fed can fight the bond market spike, or it can fight inflation. It probably cannot do both at the same time. There is no clean exit from that corner. And I want to be clear that saying this is not pessimism, it's not doomerism, it's not a prediction that this specific sequence will happen. It's just the honest arithmetic of a compound problem. More principal at higher rates, rolling over faster than the system has room to maneuver. When that problem hits a structure that was built on assumptions about gradualism, I want to tell you where I actually landed on this, because I think the honest version is more useful than a clean conclusion either direction. I came into this topic expecting to find a villain. I looked for one. I read the FOMC transcripts and the CBO projections and the academic literature on debt sustainability and the institutional investor filings. I looked at who was doing what and whether it fit a pattern of deliberate exploitation. And what I found was not a villain. What I found was something harder to name and, honestly, harder to sit with.
I found a system that has been optimized over decades to defer pain, to push the reckoning as far into the future as possible through whatever mechanism is available, and to distribute the costs of that deferral in ways that are invisible to the people bearing them while remaining entirely legible to the people who know where to look. The politicians aren't evil. Most of them genuinely believe that growth will outrun the debt, or that the next administration will deal with it, or that the bond market will give more warning than it gave Liz Truss, or some combination of all of those. The institutional fund managers aren't evil either. They are responding rationally to the incentive structures they operate within, and those structures reward apparent performance in normal conditions and punish underperformance even when the caution that produces underperformance is objectively the correct risk management. The system is not a conspiracy. It's a set of interlocking incentives that, taken together, reliably produce a specific outcome. The adjustment, when it comes, falls most heavily on the people who are least equipped to hedge against it and least informed that the adjustment is happening at all. Sophisticated players hedge. They own real assets, property, equity, commodities, that retain real value when inflation erodes the purchasing power of cash and fixed income instruments. They have access to structures and strategies that allow them to protect wealth across a devaluation event. Regular savers don't have those tools. They have savings accounts and pension promises and money market funds, all of which are denominated in the nominal dollars whose real value is the thing at risk. They don't know they're in the pool until they're already wet, and by then the distribution has already happened. Which brings me back to the question I asked at the beginning, the one I said I wanted you to hold: when governments run out of room to borrow, who actually pays? Not in the abstract.
Not in the textbook. Who specifically loses wealth, and who specifically ends up holding more of it by the time the dust settles? The historical answer from the post-war episode and from the pattern in emerging markets where this dynamic plays out more quickly and legibly is the people who paid were the people who held their wealth in nominal, fixed income instruments denominated in the currency being quietly devalued. Bonds, savings accounts, pension promises, insurance policies, the instruments that the financial system had told them for decades were the responsible way to save. Not the people who owned real assets, not the people who understood the dynamic early enough to position themselves. The mechanism was invisible. The redistribution was invisible. The politics never named it, and the pattern is not an anomaly. It's a feature of how this class of problem tends to resolve because the alternatives are all politically impossible. An explicit default destroys the credit markets. Austerity severe enough to actually close the fiscal gap destroys the economy. A sudden, honest tax increase large enough to matter is politically non-viable in virtually any democratic context. So the option that remains, the one that doesn't require a vote, doesn't require an announcement, doesn't generate a protest or a headline or a clear political accountability moment, is the slow, quiet option. The option that works through the gap between the nominal interest on your savings and the real inflation eating away at what that savings can buy. Here is the uncomfortable truth I want to leave you with, and am going to try to say it exactly as precisely as I can without either catastrophizing or reassuring. I don't know if this happens again in the same form.
There are serious arguments that the current Federal Reserve is more institutionally independent and more inflation credible than the Fed of the 1950s and 1960s, and that political pressure to accommodate fiscal needs will be more effectively resisted. Those arguments deserve to be taken seriously. The dollar's reserve currency status provides buffers that other countries don't have. The depth and liquidity of U.S. financial markets provides buffers. I am not predicting that the 1945 to 1980 playbook runs again in exactly the same form. What I am saying is that the option is on the table. It's been used before. The mechanism is understood by the people in a position to deploy it. An open question is not the same as you're fine. Because here's what I actually believe. After all of it, the risk isn't that something sudden and dramatic happens that makes everyone realize they need to pay attention. The risk is that nothing sudden and dramatic happens. The risk is that the adjustment happens slowly, over years, in ways that feel like normal fluctuation rather than structural change, in ways that only become clearly legible in retrospect, by which point the distribution has already occurred and the people who were positioned correctly are already further ahead and the people who weren't are already behind in ways they can't quite name or explain or point to. That's been the pattern. The debt doesn't default. The smoke alarm keeps going off. And somewhere in the noise, without any announcement, the stove burns down. So, who pays when governments run out of room to borrow? Not the people who understood the question was being asked. That's been the pattern before. The honest answer to whether it repeats is I don't know. Nobody does, with certainty. But I think you should know that the question exists, and what the historical answer has looked like, and what mechanism is available, and that the people who would use it are not obligated to tell you in advance. That's the thing I wanted you to leave with. Not fear. Not a specific trade to make or a political position to take. Just the sentence finished. Now you know what they weren't saying.